Over the last 10 years, I've spoken to thousands of individual investors about their investments and financial plans while working at PWL Capital, and I've interviewed some of the smartest people in finance, economics, and psychology on the Rational Reminder podcast. The lessons I've learned from those experiences are hard to condense down into a single video, but I'm going to do my best. These are all lessons that investors will learn eventually, though many will learn them the hard way. I'm Felix, portfolio manager at PWL Capital, and I'm going to tell you what I think are the most important lessons in investing. You're not that smart relative to the market. You might be really smart, but it's not good enough to be smart if you want to beat the market. You have to be smarter and faster than the competition, and the competition is, in aggregate, smarter than almost every individual. This time is always different. Crashes and bubbles are persistent features of financial markets, and they're exacerbated by narratives. The narrative is always different, but some things don't tend to change. Most notably, returns after crashes are more often positive than negative, and new paradigm bubbles tend to have disappointing returns. The market is forward-looking. The market is constantly predicting the future, and market participants have an incentive to be the first to bring information to the market. Even then, no single participant can have all the relevant information. Most of the time, a piece of information that you think gives you an edge will already be reflected in prices. Market forecasts are not useful. They're more often wrong than right, and they feed into investor psychology. Paying attention to market forecasts, and worse yet, acting on them, will not improve the quality of your investment decisions and will likely lead to unnecessary anxiety. Time in the market beats timing the market. Investors often fail to capture market returns due to poor timing decisions. Sticking to a disciplined strategy will typically be more effective than trying to time the market, especially after costs and taxes. Most funds do not beat the market. We know from fund flows that investors chase funds that have been successful in recent history in hopes that the performance will continue. In reality, funds that have been successful in the past are no more likely to be successful in the future. Some evidence even suggests that recently successful funds are more likely to go on to have poor performance, and the vast majority of actively managed funds do not beat the market over any time horizon. Incentives matter. Content creators have an incentive to make exciting, often fear-inducing content. Financial product salespeople have an incentive to sell their financial product, and financial advisors have an incentive to make investing seem more complicated than it is. None of this means that there can't be good content creators, salespeople, or financial advisors, but as a consumer of information, it's important to understand how incentives may be affecting the information that you receive. Expected economic growth and stock returns are unrelated. This is one of the most persistent misconceptions I see among investors, particularly inexperienced investors. The idea is that if you invest in the highest growth company, sector, or country, your investments will outperform. The reality is much more nuanced. Expected growth is reflected in current prices. If that growth materializes as expected, investment returns for the asset will align with its risk. If growth is better than expected, returns can have a positive surprise. If it's worse, a negative surprise. The result is a somewhat random relationship. Good portfolio management does not make up for bad financial planning. Investing is a means to meeting financial goals, but investment returns are not a financial plan. A good portfolio won't tell you how much to save, how much insurance to buy, how to reduce your taxes, or how to structure your estate. Risk and expected returns are positively related. This is important for two reasons. If you want to earn higher expected returns, you need to be willing to take more risk. And if someone tells you that they can get you high investment returns with no or low risk, you should be skeptical. Related to the last point, the risk-expected return trade-off changes based on your time horizon. Due to stock returns being somewhat mean reverting, stocks are a little bit less risky at long horizons, and due to inflation being persistent, safe assets like bonds and cash can be risky at long horizons. Fees and taxes matter. Lower fees are one of the best predictors of future fund performance, but fees are only part of the story. More active strategies tend to be less tax efficient. When the tax costs of active management are considered, even fewer funds outperform. Complexity and costs are positively related. More complex financial products tend to have higher fees and costs, and evidence suggests that complexity makes investors worse off rather than better. In investing, simple, low-cost solutions will tend to dominate more complex ones. There is no single optimal investment strategy. People agonize over the perfect portfolio, but everyone has different objectives, constraints, beliefs, and preferences. Two people can have different portfolios, with both being optimal for the respective situations. Yes, even dividend investors. The best investment strategy for you is the one that you can stick with. Sticking with an investment strategy through bad times is a requirement of capturing its benefits, but it's one of the hardest things for investors to do. Most investors underperform the funds that they invest in, and increasingly so with more volatile funds. There's no such thing as a passive investment. There's a spectrum of how passive or active a strategy is, but nothing is truly passive. Since every investment is active on some level, it's important to understand which active decisions you're making and why. Increased wealth does not give you access to market-beating investments. The supposed benefits of investments marketed to wealthy investors, like hedge funds, private equity, and private credit, are likely more fairy tale than reality. They typically come with high costs, they're opaque, and their economic benefits are not well supported. Diversification is still the only free lunch in investing. Diversification has been called the only free lunch in investing for decades because it offers the rare opportunity to reduce risk measured by return variance without reducing expected returns. Investment should be evaluated on process, not outcome. People can get lucky or unlucky with an investment outcome, especially in the short run. To avoid chasing recent returns, it's important to understand why an investment was made and what its expected outcome looks like. Probably the most important lesson is that investing has been solved. Nobody fails to meet their goals because they didn't have tail risk insurance or structured products in their portfolio. For most people, investing in a portfolio of low-cost, total market index funds is good enough, even if it's not perfect. The good news is that many, though not all, of these lessons can be acted on by simply investing in low-cost total market index funds. The problem is that a lot of these lessons are related to why it can be hard to keep your head down and stick to a strategy, even a simple one. Successful investing is simple, but it's not easy. The one lesson that index funds are not the answer to is that good portfolio management does not make up for bad financial planning. You can't buy an index fund and automatically have your long-term goals mapped out, quantified, and acted on with a plan that incorporates tax and estate planning. If you want more color commentary on these lessons, we discuss them at length in episode 299 of the Rational Reminder podcast. Thanks for watching. I'm Ben Felix, portfolio manager at PWL Capital. Did I miss any lessons that are important to you? Tell me about them in the comments.